We're going to move on with an exciting panel discussion with this team down here. Our topic is venture capital startups, fostering innovation in climate solutions. So it's my pleasure to invite Alexis Houssou, founder and managing partner of HCVC. Please welcome. Nigel McCleave, partner at Lightrock. Paul Eisenberg, investor at Kiko Ventures. Elizabeth Gilligan, CEO at Material Evolution. And our moderator for this panel, Strikovsky, partner at ETF Partners. Welcome to our stage. The room is all yours. Enjoy.
Hello, everyone. How is everyone? Okay, now the microphone works. That's nice. Cool. How is everyone doing? Thank you. So it's a very important panel, and the room would be filled with people in a second. But no, honestly, we actually talked a bit about what we will discuss, and there's quite a few topics we'll try to cover today around the topic of VCs and fostering innovation. But maybe we start with a round of introductions. So I'll introduce myself, Tomer. I'm a partner at ETF Partners. We're a London-based sustainability fund. $500 million AUM, focusing on Series A and B in Europe. For the rest of my panel, I do want introductions from each, but I also want you to add which innovation you're most excited about and wish more people mention and discuss, kind of overlooked. Nigel, let's start with you.
Thanks, David. Hi, everyone. I'm Nigel McCleave. I'm a partner at Lightrock. We're a global growth equity fund, typically starting at the Series B stage and later. Most relevantly for this panel, we have a $1 billion climate fund, where we're typically investing checks of as small as 10 and up to $50 million into climate tech startups. I think your question about which area I'm excited about is accompanied by a question about which is most overlooked. And I guess I'll go with a shameless plug for an area of one of our portfolio companies, which I think is the O&M industries for the big renewables. If you look at wind, for example, the first or second fastest growing job in the developed world over the next 10 years is going to be a wind turbine technician, which is quite strange when you think about it, but is hugely kind of a powerful step. The backlog of services for the large OEMs is 50 billion plus. And I think if we're going to have wind, and to a lesser extent solar, be a sustainable part of our energy system, then actually having sustainable and proper services in those sectors is going to be important. And I think there's a lot of private equity roll-ups in that space of the old-fashioned stuff. But the innovations around monitoring and repairs, I think are going to be really exciting.
Cool. Thank you, Nigel. It's over to you.
I'm CEO at Material Evolution. We're a sustainable cement company. So we're looking at how we reduce emissions by 85%. We're looking at how we do that on an industrial scale. The area I'm interested in is building materials. I'm not going to plug cement too much. For me, I think how we build the world has to be how we decarbonize it. I think software has a role to play, but I think that VCs need to be putting their money where their mouth is in terms of investing in hard tech.
Cool. We'll come back to that. Alexis, over to you.
Yeah. First, thanks for having me. Really excited to be here. I'm Alexis Houssou. I'm the founder and managing partner of HCVC. The HC in HCVC comes from Hardware Club, which is a community I started about 9 years ago now, with the idea of bringing engineers and kind of founders of hardware companies together, since we felt they were too isolated and there were some lessons to be learned. And out of that, we built a venture firm. We now have 130 million under management across 2 funds. We really look at climate from the hardware perspective. We think there's a lot of opportunities. Out of the things I'm mostly excited about, I think we've done a couple of investments in nuclear energy. I think it's really exciting. I think there's a lot of bad press and a lot of wrong feelings around nuclear energy. It's actually very safe. And there's a lot of innovation that's still to be implemented, right? So we're quite excited about that. We invested in a company in France doing fusion, and we invested in another company out of Switzerland that's called Transmutex that's working on transmutation of nuclear waste. So yeah, very excited about that.
Cool. Paul.
Hi, thanks for having me as well. I'm an investor at Kiko Ventures. We're a climate fund based in London, a multi-stage evergreen. We invest in all the climate verticals, all of Europe. So pretty much any deal that we see, we can seriously consider investing in. We're quite flexible. I interpret this like Nigel. So what's an overlooked area? I think, I think policy innovation is something I'm quite excited about, even more so as a world citizen than as an investor. So the way I see the world is sort of that we have all these experimentation labs with the Green Deal, the IRA, and so on. So we have basically regions learning from each other, and I think the biggest part of the differences on the ground can really be explained by differences in policy. So we as Kiko try to stay very close to policies, and in the upcoming in the election in the UK, for example, see a role for us to also help shape policy.
Cool. Thank you for that. So, as I mentioned earlier, we'll just jump between a few topics. And the one I want to cover quickly, given that we're in the Energy Tech Summit, is energy tech, and specifically energy tech investments. So over the past 2 days, I've heard from a lot of people about how energy is a bit hyped at the moment, energy technology, maybe alongside AI or slightly less. But still a lot of generalist funds, kind of classic VC funds, piling in, competing for investments in the space. And I was wondering, what are people's views on the ability of generalists to replicate success in things like software, but coming to this much more nuanced, complex industry, such as energy? Alexis, maybe we start with you, given your background in hardware and investing in things like fusion. What do you think are kind of the pitfalls for people coming from outside the industry investing in energy technology?
Yeah, I think it's a good question. I do think there's a lot of generalist funds that are very interested in climate, but from the software angle. So that's I think, when I talk to people that are into climate, I always kind of ask, because I think a lot of them are, would tell you, yeah, we're very excited, but then you send them, you share a couple deals, and they're all like, oh yeah, we didn't touch hardware, which is kind of surprising, given energy is a requires at least hardware a few steps of the process. So I think one of the things that is quite important, at least for us, and when we're looking at energy tech companies, is we're quite often at the trying to evaluate whether those businesses are venture fundable. I do think there's a lot of innovation that's needed for the world in terms of decarbonization of industrial processes, etc., that needs to be funded, but I'm not always sure that venture is the best kind of case for that, because a lot of sometimes cases we see, there's a lot of capital intensity, which we're fine with, I guess, but if you have some capital intensity at the beginning of the life of a company, and they need to build some initial IP, and then afterwards you can kind of see this decorrelation between the capital raised and revenues, that's okay. But in a lot of cases where I see opportunities where it feels like you need to raise hundreds of millions and then not necessarily a potential for billions in revenues afterwards. So it's more of a you can't really decouple kind of the money in and the money out, I guess. So I guess that's one of the things that even us were struggling with. A lot of opportunities that we like, where we feel like, well, this would have a big impact. We can't really see this kind of decorrelation, I guess. I think that's the main thing from our perspective. Yeah.
Cool. Nigel, maybe your perspective, given that you're a growth investor and you can also invest in different sectors, so energy is very much a choice for you. How do you view things? Do you feel that the valuations you see in earlier stage stack up when you look at companies at the later stages?
Yeah, I mean, I think the first thing to kind of just discuss, and I don't have an answer, but I feel like the seed and Series A part of the world is relatively well defined and well understood. And then you get to growth. And growth can mean like a $15 million investment in a bootstrapped EBITDA profitable company. It can also mean like a $250 million investment in like a moonshot that has negative gross margin. So I think the area of growth is so diverse, and I don't generally like talking about growth investing, because even in our portfolio, we have like profitable companies. We have companies that are burning like 20, 30, 40 million dollars, a year that like require a lot of capital intensity. So I think the nuances of what kind of capital is required for what kind of company are very specific once you get past a certain point. In terms of valuations, I think, again, if there's a company that's in climate, in software, has unit economics to work and is close to break even, that company is going to be valued through the roof because there's so much demand for that kind of thing, right? If there's a company that's, the ironic thing actually that I see bootstrap companies that are profitable being valued, that may not have come from the VC ecosystem, at a much lower valuations in general than the ones that have come through the VC ecosystem. When you break it down, you ask yourself, why? And it's because, well, actually, the early stage VC investors need their marks. And like, it's kind of going on that kind of power law journey as opposed to a more sensible kind of, let's make 2 to 3x type journey. So, I mean, I don't think, to your specific question, I can make a comment about where our valuations in general. I think we're not back to 2021. I think investors are more discernible at the growth stage of paying reasonable multiples, having unit economics. But I do think that how a growth investor constructs their portfolio it can be so varying, right? And that determines really what any one type of investor is willing to pay for any one type of company. And I think the most important thing for a founder, whether they come through VC or not, is to understand that and to identify the right type of investor for their business.
Right. Liz, how have you experienced it in the founder's shoes, and especially in something novel such as what you do? And maybe if you can say a couple of words on exactly what Material Evolution does, but also then comment on, have you seen this kind of hype in energy trickle down to your sector as well as part of the climate tech boom, so to speak?
Yeah, that's a great question. I mean, I'll make it PG because I'm on a panel with all VCs, so we won't go too harsh on the values. At Material Evolution, we're using a process called alkali fusion to make house cement. It's a non-heat process that allows us to get that 85% reduction. Unfortunately, we don't believe there's going to be one material to save the world. We think it's going to be varying feed sources. We think there's going to have to be a hardware and a software play together, so we have our own software that comes along with that. And for us, it's about scale. You have to be at an industrial scale to make a difference in the cement industry, and that's what we're going after as aggressively as we can. So that's kind of Mevo in a nutshell. In terms of investors, I think, in this space, I mean, I think it's great. I would argue there is limited value VCs can bring to early stage companies. And I think what they're really great at is pattern recognition, that support on introductions, those next steps. But they're not going to change. You invest in the company and the founders and the tech. I don't believe that VCs are the instrumental ones changing their portfolios. They're helping to guide them, not changing them.
How was fundraising for you? I think you've raised more than one round. How was it recently, would you say?
More diligence, but we did raise more money. We were really lucky. The market we had good offtake agreements, things like that. Like for us, it was really led by partners. We developed like kind of business case that was, we haven't made revenue, but we've signed contracts for 35 million. So rather than, because I think it's super hard in the early stages to make revenue in something that you've got to spend 10, 15, 20 million on CapEx. So how do you kind of navigate that? For me, it was spending a lot of time getting to know the VCs, because I think you have to be really mission aligned. You have to make sure that they understand that piece. And that was a key thing for us. But it took a bit longer than we wanted in terms of, I like to do them in 6 weeks. That's how quickly we did our first round. But I think spending the time getting to know people.
Cool. And so on your previous point, about VCs being helpful or not, and also generally whether this is the right type of capital for climate solutions. That's kind of going to be our next topic. So, Paul, I actually want to pass it to you, given Kiko Ventures is an evergreen fund, and kind of discuss the topic on whether VC is at all right for climate. But maybe if you can start helping the rest of us understand what evergreen is.
Let's maybe start. I'll start with a problem that I guess some of these hard tech, some deep tech companies have, and sort of why they need a special kind of funding mechanism. I think there's two major ones. One is sort of the time to maturity. So they often take a lot longer until, I guess you could sell. You could get an exit as an investor. So I think you have a problem with the normal 10+2 fund model. And the other one is sort of the valley of death that's been discussed a lot, where if you're a hardware company, you want to raise money for a sizable first of a kind at some point. It doesn't really work properly for the growth investors or for the early stage investors, and then sort of you have a funding issue. And so the way we try to address that is, the first one is we have an evergreen fund model where we basically have a floated balance sheet, a stock market floated balance sheet, and we can be a lot more patient and purely IRR driven. On the second bit, I think that's really a problem of, I guess, partly an information asymmetry problem and partly an expectations problem, where you're kind of handing over a company throughout its life cycle to different investors, so at some point nobody wants to take the company at the first of a kind funding stage. And that used not to be a problem back when innovation was done within corporates and it was all done within a single hand. And so us trying to do multi-stage investing is kind of trying to solve this issue. Basically, we're trying to solve these information asymmetries by being the same person that funds the company throughout a lot of stages.
Okay, so maybe to have a bit of a debate on that, because most funds out there, and probably 90% of climate funds, are not evergreen. Well, it sounds like for startups, it's actually quite ideal that they would be. They invest forever, they top up, they go multi-stage. Alexis, you do deep tech. You did not structure your fund as an evergreen. What do you think are the pros of keeping the kind of standard VC limited time model?
I guess raising capital from LPs is the, is the obvious one. I mean, I haven't tried going to LPs and telling them, well, you know, listen, invest in our fund, and I don't know when I, you know, pay you back or give you, you know. But I don't know what success I would have had. I mean, you know, I do think it's an interesting model, and I think quite complementary to what you can do with traditional funds. I do think, in general, you can fund deep tech through the traditional 10+2 structure. I was reading actually looking at data not so long ago from PitchBook, looking at a large data set of companies, and when you look at deep tech companies versus traditional companies, you don't really get a big difference in terms of how long they take to exit. You know, the small difference is they need slightly more capital, but it's not very, you know, significant, I would say. So the main thing really, I guess, for us is really just finding the right companies and you know, like when you are, and there's opportunities to, you know, to ride that wave and be with the founders. And what we've seen, at least in our portfolio so far with our first fund, which is 5 or 6 years old now, is that we've actually had quite a few early exits where companies build technology for the first few years, they build IP, and once that IP is built, there's two paths. One, you raise more capital, you go big, you try and distribute, etc. If you can't really do that, or if you think that's not the right way, you can also go to a corporate that already has the distribution and just say, well, this is a product we've built. We think it's really relevant to your customers, and get some early liquidity there. We've been able to get that a few times, and I do think that's something that favors deep tech or hard tech companies or IP-heavy companies more than traditional software businesses.
Alexis, if I'm a founder and there's two funds offering me a term sheet and I really like both funds, is there an advantage for me to take a term sheet from a standard VC or traditional VC versus an evergreen model?
Is the question to me?
Yeah,
or?
To you,
oh,
to you.
Okay, I thought the question was for the entrepreneur. I don't think, I think you want to, I mean, what I would tell my founder that gets through term sheets like that, I would be like, which fund do you like the most? Who do you want to work with? I don't know that make the decision based on whether that's an evergreen or traditional fund. I do think, the evergreen thing, if it's built within the, the spirit of the fund and there's a whole, like we're going to be there with you for the long run, etc. I do think it's an argument, but I think that would be one of the 5 or 6 things you want to look at as a founder.
Yeah, cool, thank you. Switching a bit or picking on someone else a bit. Nigel, we've seen in the last few years a lot of really big climate growth funds. You guys were one of the first ones, actually, but then we've seen also others such as General Atlantic, Morgan Stanley. Is there a need for a dedicated product around growth when it comes to climate companies, or actually there's other reasons why we see so many growth companies focusing on climate now?
So there's a question, do you need to be a specialist climate investor?
Exactly.
Look, again, I think it comes back to my point a little bit about what does growth mean, right? Like if you're investing $200 million in a pre-product technology business, then yeah, you better like damn understand that technology, and you probably need to be a specialist for that. If you're investing maybe even the same amount, but like 20, 40, 50, $100 million in a company that has product market fit, revenue, maybe profit, then actually I think for that kind of growth capital, I think you need to be slightly less of an expert in the underlying business, and it's more about assessing product market fit, seeing growth trends. I think anytime there's numbers and tractions, like I joke that growth investors like to put a ruler on a page, right? And kind of say, okay, we're doing 20% this year, 20% next year. And I think when you have commercial traction in unit economics, it's much easier to assess as a generalist than when you don't, and it's slightly more deeper tech. Like, we have a company like Sunfire in our portfolio, right? I don't pretend to understand, green hydrogen electrolyzers, but like I've got a colleague who is more of an expert in that. And so I think for something like that, it's very important. We have another company that's called Distribution, which is a software business. And actually the person who led that deal was just more of a horizontal SaaS expert, right? And picked up on some nuances in the climate space that are important. I think the one thing I would comment on, and also to your point on the value add, I completely agree that VCs often overpaint their value add. I do think that having a climate-specific ecosystem can sometimes be helpful, but I would actually paint the other side of the picture, which is I've seen VCs be very value destructive when they don't understand how to grow a certain type of business. And maybe you've seen this, Alexis, but I've been on boards with software-only investors in a hardware business where you're trying to invest for growth, to grow, without an understanding actually that raising more money at higher valuations when unit economics aren't quite proven isn't the way to do that. And those companies end up being bankrupt, right? Whereas, maybe a hardware business, it might require a little bit more capital up front, but also maybe grow slightly slower until you've kind of proven things. And so I think that level of pattern recognition does lend itself to specialism for certain types of businesses. And I think, does that necessarily need to be climate? Sometimes yes. I think in climate there are more types of businesses that are similar. So I think that pattern recognition, in order not to be a value destructive investor, is quite important.
Liz, last question for today. Is climate a hardware problem?
For me, yes. Like it has to be.
But would you say generally beyond material evolution?
Yes. I would love it to be a software problem. I would love it if we could solve it with software. Software, when we're building the factory, I curse myself for starting a hardware business sometimes because they're hard. But I don't understand how we get to where we need to be without it being a hardware problem.
Paul, what's your view about the role of software in solving the climate crisis?
I'm sort of not quite all the way there, but I think pretty far. I do think it's to a large extent an atom and not a bit problem. And but I guess I would slice it slightly differently. So it's also a hardware problem, not only a hardware problem. So there's a bunch of stuff we need to invent. That's, I think, I heard estimates 40% or so of decarbonization. There's a bunch of stuff we just need to roll out that already exists. And that's a combination of hardware and software, and really the challenge is finding business models that makes us able to roll this stuff out. And I think it's an intersection between the two.
But the thing is, right, NVIDIA, Tesla, Apple, I think software VCs are now with software business because they scale easier and in a more asset-light way, and it's easier for early exponential growth. But I think the range of outcomes, like provided you incubate and grow businesses appropriately, like in the hardware space, they don't need to be smaller long term, right? I think they just require a different skill set initially, right, and a different mindset. And I think provided you have founders and investors who understand that, then you can build super big companies, right? And I think we need to, right? To your point about being a world citizen, right?
I like your comment, and it's a really good one to finish on this note. So thank you, esteemed panel. Thank you, everyone, for listening to us, and see you later in the main area.